Howdy friends, Joel Garris here of Nelson Financial Planning. This is Dollars and Cents. We're Central Florida's longest running radio program, but we're also out there on the internet as well as a podcast. Recently named by the folks at FeedSpot one of the top 25 financial planning podcasts on the World Wide Web. We're going to answer a couple of very important questions today. First, have you gotten your check yet? That's what everybody wants to know. That's what on everybody's mind, because these stimulus checks from the government started showing up in people's bank accounts this past week. And good if you got one, but maybe you didn't get yours. So we're going to tell you what you need to do to find out when yours is coming. Plus, we'll also sort of answer the question of why the market's kind of hanging in there as decently as it is when you consider the large swaths of the economy that are effectively closed. So we will tackle all of that, but first and foremost, of course, we got to get to that main question. Did you get your check yet? Because everybody is looking for it. Of course, it's not a check, right? I mean, it shows up as a direct deposit. And just to recap how much you should be looking for, it should be $1,200 per person. And then for every child under age 17, there should be another $500. So potentially for a family of four with a couple of young kids, you could be getting $3,400 of a deposit, which is obviously a pretty significant amount. Before you start to go and look for your stimulus deposit, you sort of need to ask the question of whether you are eligible in the first place. So remember those parameters. If you're single, you got to be making less than $75,000. If you are married, it's got to be less than $150,000. Below those thresholds, you get the full kit and caboodle of the $1,200 per person. If you are above that, then it starts to phase out. If you're single, you still get a little bit. It gets reduced up to $100,000. If you're over $100,000, forget it. You're not going to get anything, so don't even bother looking. If you're a married couple, again, starting at $150,000 starts to phase out. As you go above $150,000, above $200,000, yeah, you're not going to get anything. So know that part of the eligibility requirements. In order to determine that, you've got to look at your 2018 or your 2019 income. And depending upon which return you have filed, that's the one they're going to go with. So for those of you that have filed your 19, they're going to look at the 19. If you haven't, they're going to look at the 18. In some cases, and obviously this is all a moving target that's developed over the past 30 days, you've got to take a look at which return actually has the lower income number. If your 18 return had lower income than 19, well, then maybe you want to hold off a little bit on filing that 19 return, have them look at your 18, and then pick up the stimulus that way. So if you've already filed your 19, it is what it is. But for those that were late, I guess that's a situation where the early bird might not have gotten the worm this time around. It certainly gives you some flexibility. So you've got to have below the eligible income levels in order to get the stimulus deposit, and you need to look at your 18-19 return to see where that income falls. And then lastly, you must have a Social Security number. So those are the basic parameters for your eligibility. The first wave, as you probably are aware, started this week. Again, we are coming to you on this program Thursday morning, and so we are not in the studio yet. We might be able to start to do this through the studios on Sunday, hopefully in the next couple of weeks. But for now, we're still doing the program on Thursday morning. So it's Thursday morning and you are already starting to hear folks that saw those deposits show up into their bank accounts. The first wave was kind of the easy wave. It's estimated that about 60 million people were covered by sort of the easy wave, if you will, this week, where certainly fell below the income requirements, had filed a tax return, and had also included bank account information on that tax return. That was the easy wave. So first of all, understand the difficulty involved in this process, right? I mean, this is a massive process to try and deliver this money to the American people in a very short period of time with an agency, the IRS, that is in of itself short-staffed, number one. Number two, it also is working remotely like so many other businesses. So it's really difficult, and in a way it's almost incredible that they've been able to turn this around as fast as possible. Understand though that there's always going to be issues, there's always going to be mistakes, and as discussed last week, I mean, the IRS is really trying to go as fast as possible on this. But there will be some issues, and certainly if you look at some of the stories that I've already heard, where we saw twice yesterday, recent widows were getting a check for their deceased spouses. Not sure how they're going to resolve that one, but we saw two examples of that just yesterday. So it's a little bit of a moving target for sure. But if you're in that easy group, that's group of 60 million people, you filed your return, you've got bank account information, or for that matter, if you're getting Social Security and seeing that direct deposit, then you should be getting it automatically. Okay, so that's easy, right? If it already showed up, hey, you're happy. But what about the rest of the folks that are still looking for it? So those people are going to fall generally into one of two different categories, and we want to walk you through this morning on how you might be able to follow up on it. So category one is those that don't have a bank account on file. Okay, file the return, you're eligible, you know that, you've got a Social Security number, but you didn't put a bank account on file on your tax return. The other group is the group that's actually a pretty significant size of the population. It's the group that doesn't pay taxes. So, and it's estimated that about 44% of Americans don't pay taxes. So that's a much bigger group than what you might originally think. So we've got two groups of people. So the very first thing, and we're going to do a little bit of show and tell here. So bear with us because it's hard to do show and tell on the radio, but as you all know, not only do we do this radio program, we convert it over to a podcast, and from there we put it up on our YouTube channel. So for this portion of the program, if you'll slide over to our YouTube channel can be found simply by going to YouTube, typing in Nelson Financial Planning, and you should see our channel come up on YouTube. So the very first thing you want to do is get yourself a handy little laptop, right? A Chromebook in this case. And the site that you want to go to is irs.gov. Please don't Google how do I get my stimulus check or anything like that. Don't rely on Google to direct you to the correct site, because there's a lot of fraud going on out there with these stimulus deposits. So please just go into your taskbar and type irs.gov. What will come up is a site that looks like this, irs.gov. That's where you want to go. Now, from there, you will see that they've redesigned the website, and they've got two different boxes. They've got a non-filers enter my payment here, and then they've got a get my payment. So if you're in the group that did not have bank account information on file, you want to go to the get my payment tab. Click on that, and then you will see a scroll down a little bit. You'll see a get my payment button. You click on that, and then you're going to be given, it's for authorized use only, blah, 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 the government disclaimer. Don't mess with this if you've got nefarious reasons. So you click on that, okay, and then it comes up, get my payment. Put your Social Security number, date of birth, street address, and it continues, okay? So that is the process for getting a deposit of your stimulus check if you don't have bank account information on file with the IRS. So that's the first group of people. The other group of people is the 44% of Americans who don't actually pay taxes. They are eligible for the stimulus check or the stimulus deposit, and that is this tab right here. The non-filers, enter payment information here. Okay, so you click on that, and here's the thing about this one. This one will actually, once again, you scroll down. If I can scroll down here, scroll down, there we go, and you get to a non-filers enter payment information here. Click on that, okay? And then this redirects you to a site. So don't freak out when it gets redirected to a site. It redirects you to a site. That site is freefilefillableforms.com. From there, okay, you've got to click the Get Started button and then create an account and blah, all of that normal stuff, okay? So that's the process for folks that are not, don't have a return on file with the IRS, and you go through that process. Again, can't emphasize it enough. Make sure that you type in irs.gov. Go to the right site. Don't just Google a random search, because that could get you someplace else. Go to the irs.gov website and start the process there. They've redesigned. Remember, you go to the tab that says non-filers enter payment info if you do not file a return. And so there's no way for them to get you the check. I mean, obviously they could put it in the mail and kind of track you down that way, but there's estimates that say that that's not going to get to you until like September. So do this process, understand what the process is. If, on the other hand, you are still looking for the payment, maybe you haven't put your bank account information on in it, then you certainly want to go to the Get My Payment tab of the irs.gov in order to make sure that you're getting that stimulus deposit as quickly as possible. So very important stuff. Hopefully we've been able to kind of walk you through here on air on how to get that or how to check on that. And most importantly, if you go to YouTube, you'll see where we picked up the little laptop and actually clicked on the links and showed you the link. So hopefully that came through on the video. Anyway, we're going to slide to a break. When we get back from the break, we're going to talk a little bit about those first quarter statements that many folks got over the course of the past week or two, and really start to dig into, okay, what's going on in the market, particularly when we look at those first quarter statements. So stay tuned for that through the break. We'll be back. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen. Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents on News Radio WFLA, or maybe you hopped over to our YouTube channel, Nelson Financial Planning, to see the demonstration we did in the prior segment about how you can track down what's going on with your stimulus deposit. Maybe you didn't have bank account information on file with the IRS. We showed you how to do that and add that and give that to the IRS so to speed up the delivery of that deposit. Or maybe you don't actually file any taxes. Maybe you don't owe any income taxes. You still have eligibility for the stimulus deposit. We showed you how you can go through that process as well. Bottom line on all of that, make sure that you type in irs.gov. That will direct you to the IRS site. Be careful about trying to Google it or find it that way, because there's a lot of fraud out there in terms of how all of this is playing out. So make sure you go directly to the IRS website, which is at irs.gov. That's where you can track this down and give them the information so that in order to get your check. You'll still get your check if you don't do any of that, but it may not be until September. So you might want to do some of those steps we just talked about in the prior segment to make sure that you get that stimulus deposit faster. We're going to tackle the topic of what's going on with those first quarter statements and the relative to performance of the market. But before we do that, I want to talk a little bit about a couple of issues / opportunities, if you will, that the stimulus package had in it that perhaps we haven't heard that much about. I know we've talked about them on the program a little bit, but we want to be sure to mention them again so that people are aware. The opportunity is the opportunity that comes when the stimulus bill suspended the required minimum distribution for the year 2020. So if you're over age 70 and a half, then you've got a required minimum distribution. Now understand that the Secure Act, which was passed at the beginning of the year, actually increased that age to 72. The reality is that that age and the required minimum distribution, if you've got the required minimum distribution that's due this year, you can in fact elect to defer it, meaning you do not have to take it. Why would you do that? Well, a couple of different reasons, right? Because with the market down, you definitely don't want to take stuff out when it's down, because then that means you're selling more shares to generate the same amount. Number two, remember 2019, and how quickly we forget, 2019 was actually a very strong year for the stock market. So that meant that your required minimum distribution was probably a little bit higher than what it was on the prior year. So you had an increased required minimum distribution, and now you've got a market that has gone down, and so at least you have the opportunity to say, hey, you know what, I'm not going to take it, and I'm not going to take that larger amount anyway, because remember, the required minimum distribution is based upon how things were at the beginning of the year. Well, obviously, things now are very different than they were at the beginning of the year, so you have to certainly be aware of that option. So you have the option to suspend the required minimum distribution for the year 2020. However, you still have the ability to do a qualified charitable distribution. So what's interesting about this is they've suspended the required minimum distribution rules, but they have allowed you to continue to make a qualified charitable distribution. Again, how that works is you tell your IRA custodian, make a check to your favorite charity. That check then is made payable directly to them, and then that money comes out. And how that works is that distribution out of your retirement account does not count as any amount of income on your tax return. Basically, they offset. If you follow the rules of a qualified charitable distribution, take the money out of your retirement account, have the check made payable directly to the charity, then it winds up being a wash. So you're able to take money out that otherwise you'd have to report as income and pay taxes on, but because it went directly to a charity, then you can deduct that same amount on the front page, regardless of whether you itemize. So a nice, powerful technique to do that. That qualified charitable distribution option still exists. So that's good to the extent that you were funding your charitable giving through your IRA. You can still continue to do that, and it still will not have any impact on your taxes. Now, it appears, though, that this suspension of required minimum distribution rules does not apply if you are taking money out of a beneficiary account and you're doing that based upon a life expectancy. If you're doing the so-called stretch IRA concept, it appears, based upon the reading of where the interpretations of the stimulus bill are at this point, that you cannot suspend your required minimum distribution that is part of your stretch IRA. So make sure you still continue that. If you've got a beneficiary IRA, you still need to take that out. In contrast, a little bit of a tweak here, if you're on an accelerated payout of a retirement account, which would be the 5-year rule, if you were taking money out over a 5-year period of time, the rules suspend it so that you actually can now take that out over that additional year. So you could take this year off and just have an extra year on that 5-year window. So some very different circumstances in terms of how the required minimum distribution rules work, or the suspension of the required minimum distribution rules work, in connection with inherited accounts or accounts that are already on a distribution schedule. So if you're on a stretch, you got to keep going with the stretch. If you're on a 5-year payout, you can take a year off and extend that for a 6-year. But bottom line, required minimum distribution rules are suspended for the year 2020. Qualified charitable distributions still exist as an option, so that's still an option for you, but know that you do not have to take the full amount of your required minimum distribution. So an important opportunity there for investors to have the flexibility to not have to worry about taking that distribution if they don't want to. So a great opportunity there. We'll get to one of the issues that this stimulus bill sort of inadvertently created later on in the program. In the next segment, we'll talk about those statements and give you some relative perspective on the market and what's happening in the market these days. So stay tuned for that. This is Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando, coming to you live-ish, taping on Thursday morning, and as is the case these days, not quite able to do it in the studio, but hopefully here in the next couple of weeks we'll certainly be able to do that, and we look forward to kind of getting back on a regular schedule, if you will. Speaking of regular schedules, here we are mid-April, and that means that you by now probably have gotten a copy of your quarterly statement for the first quarter of this year. And what's interesting about the reaction, and make no mistake about it, okay, those first quarter statements were pretty ugly, and obviously the virus continues to wreak a lot of volatility in the markets overall. But those statements, generally what we're hearing, even though they weren't great, and obviously there was a significant market decline in the first 3 months of this year, what's interesting is the perception when people actually look at them are, well, wait a minute, this isn't quite as bad as what I may have thought. We've heard that a number of times from folks as we've just been talking to them in general here at the office. And so if the statements aren't quite as bad as what you thought, we thought it would be interesting to delve a little bit deeper into why that is the case. And we talked a little bit about that on the program over the past couple of weeks. Obviously, the CARES Act, which is the stimulus package that the folks in Congress passed, $2.3 trillion. I mean, that's a lot of money, 10% of the overall economy, and a 50% increase in government spending over 2019. Huge numbers on that. And obviously, the market is responding positively to that, and certainly the actions of the Federal Reserve lowering interest rates and basically saying, hey, we're going to backstop everything and anything and everybody is a very different play out of circumstances than, for example, what we saw in 2008. So what the markets have done is at the lowest point on March 23rd, so far they were down about 34%. Today, depending upon how Thursday plays out and then Friday, at least at the time of the show, they were down about 14%. So to go from being down 13 to only being down 14 really should be asking the question, okay, so what's going on there and why? And certainly we think the biggest is the stimulus. Obviously, that's a lot of money that is just getting pumped into the economy. But there's a couple of other points that we also want to bring up that I think are getting missed along the way. And because there's a difference between what's going on in the economy versus what's going on in the stock market. And usually those two kind of work sort of hand in hand, but this is one of those times where you have to understand the nuances of the economy versus the nuances of the stock market. Clearly the sectors that have been impacted here, okay, are a huge part of the U.S. economy. Entertainment, leisure, hospitality, retailing, auto sales, the list goes on. Huge amount, and energy, of course. Those are the sectors that have been dramatically impacted by this virus and the shutdowns that have occurred. Those sectors account for almost half of U.S. jobs. 45% of U.S. jobs are in those sectors. Again, entertainment, leisure, hospitality, retailing, auto sales, energy, that kind of stuff that has been most affected. Okay, but they impact the stock market to a lesser extent than you may realize. Why? Because remember, the market is weighted based upon capitalization of the companies that make up the market. Okay, so what that means is that the more valuable of a company I am, the greater the impact I'm going to have on the stock market. Valuation of a company is not based upon the number of employees it has, right? It doesn't matter how many employees you have. If you're creating a valuable product, then the market is going to reward that business and increase the valuation of that business. So remember, stock market based upon market capitalization, which reflects the value of companies, not the number of employees. So that's a key difference. And here's why. Because when you look at the numbers, the most affected sectors in this virus economic downturn account for just 22% of the S&P 500. Let me say that again. The most affected sectors in this economic downturn, this shutdown, this virus-related shutdown, account for 22% of the S&P 500. 45% of the jobs, absolutely, but 22% of the performance of the S&P 500. What accounts for the rest of it? Well, those are the other sectors. So what's the other sectors of the economy? Technology, financials, healthcare, communications, internet retailing. Seeing the difference here? Those may not account for as many employees proportionately, but they account for 78% of the S&P 500. Some interesting numbers on that, don't you think? So I've got all of these sectors that have been dramatically affected and account for 45% of the employees of the U.S. labor force. But at the end of the day, they only account for 22% of the stock market. The other 78%, that's almost 80%. That's a huge chunk. Tech, financials, internet retail, healthcare, communications, they account for 78%. So hopefully that gives a little bit of perspective in terms of what's going on with what's going on in the economy, what's going on when we drive around and we see all of the devastation in the travel and leisure and entertainment and dining areas of the economy that employ a lot of people proportionately, but in fact, from a market capitalization, from an impact on the market, not as much. So an interesting little disconnect that's there that I think many people are missing, but they're starting to maybe see it at least when they look at their statements and say, okay, well, wait a minute, this isn't as bad as I thought. Why would that be the case? That would certainly be the case once you kind of know the makeup and the dynamic of what ultimately drives the market. The second thing to consider is the reality of interest rates, right? So as of Thursday of last week, the yield on the 10-year Treasury was 0.73%. 10-year Treasury, you can loan money to the U.S. government, and that, after all, is what a Treasury security is. And you loan money to the U.S. government, they agree to pay you back over the next 10 years at what you put in, and they'll also pay you a little bit of interest, okay? Classic loan structure. That interest rate, though, your profit, is 0.73% as of last Thursday. So I'm going to loan money to the U.S. government. They're going to agree to give me back my money, and the only kicker I get is an interest rate equal to 0.73% per year over the next 10 years. Okay, so the S&P 500 as of last Thursday was down about 18% from its peak, had a dividend yield of 2%. If it takes, and here's the crazy math, if it takes 10 years for the S&P 500, the markets, to recover that 18% decline. Remember, it made back almost that amount within 30 days, again from the low on March 23rd. Let's just say, it's going to take 10 years, okay? The reality is that if it does that and the dividend yield stays at 2%, the average annual return in the S&P 500 then over the next 10 years would be still 4%, which when you compare that to 0.73%, that's 5 times greater return than what you would get if you were owning a U.S. Treasury. So that in and of itself, because of the low interest rate environment, is creating a tremendous amount of demand for the stock market, because the reality is, where else are you going to go? I'm sorry, but 0.73% of a return over the next 10 years is not going to be satisfactory. I hope you would agree with that. The reality is, though, that if you look at the market and just give it a little bit of performance over a 10-year period of time, adding to that the dividend yield that's already at 2%, well, then you wind up with a return potential of 5 times greater than what you would get on a U.S. Treasury, and we're certainly not overestimating what the market might do over the next 10-year period of time. So remember that, and when you're thinking about what's going on in the market and how that all is playing out, because there's certainly still a demand for stocks because, again, the alternative pretty crappy when you look at it from a rate of return perspective. So some things to think about, some perspective in terms of what's going on in the market and what you saw on your statement. Perhaps not as bad as you might have expected, and that is certainly a big reason why. So we will slide to the break. When we get back from the break, we're going to circle back and talk about one issue that all of this virus and stay at home and schools shutting down is creating that folks need to be aware of, particularly if they used a 529 account to pay for college. So we'll talk about that after the break, which we'll slide to here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, to the program here on News Radio WFLA Orlando. This is Dollars and Cents, Central Florida's longest running radio program. Recently named at the beginning of the year by the folks at FeedSpot as one of the top 25 financial planning podcasts on the World Wide Web. I'm Joel Garris of Nelson Financial Planning, and we're talking in this segment about one of the issues that sort of has been created amongst all of these changes in this virus normal that we all are living in now. And what I'm speaking specifically about is the fact that many colleges have gone to remote learning. And as you know, if you're a regular listener to the program, my oldest is was at Auburn doing his freshman year. And so he came home for spring break. And lo and behold, couldn't go back, which was about halfway through the spring semester. So half of the spring semester, he was not in his dorm, and he was not eating their food, he was eating our food. And so that is creating a situation where, at least supposedly, I'm being told that I will get a refund, at least for the room and board portion and the food portion of what we paid at the beginning of the semester. So here's where it gets a little, I guess, unique. Let's say that you used a college savings type of an account. In our case, it was a 529 college savings account that had been set up by my late father-in-law, Jack Nelson, for the benefit of my kids, his grandkids. And so we used that, or a portion of that account, to pay for this spring semester. So when you use a 529, though, you've got, or any other type of college savings vehicle, you've got to use that money for college expenses, right? Because that's how you avoid the tax issue. Remember, you set up those types of accounts in order to have the growth be done on a tax-free basis, assuming you used it for qualified educational expenses. Okay, so this is where it gets a little interesting. So you get a refund. So you took money out of the 529 account, like I did, paid for the semester in full at the beginning of the semester, because after all, they require you to do that, and then you now get a refund. Well, you've just found yourself in a bit of a tax trap, because if you take the money and you use it for qualified educational expenses, it's tax-free, but when you get a refund back of that, then you no longer used that money for qualified educational expense. That changes the character of how you use that money. So instead of using it for educational purposes, wound up getting kicked back to you. It wasn't used for educational purposes. Guess what? You've got to pay taxes on the earnings, plus you've also got to pay a 10% penalty. So that's significant. and be aware of this. You may be tempted to just take the refund and say, fantastic, I got some money back. Okay, I'm never going to get money back from my kids' school. Okay, they're just going to ask for more and more money, and then even when they're not asking for money for tuition or room and board, they're asking me to donate it. Okay, so I'm constantly getting asked, this is for once I get money back, I'm going to take it, I'm going to put it in my pocket, and I'm not going to worry about it. Don't do that, because you could find yourself in a bit of a tax trap a year from now, because then that meant that that money that you took out that was supposed to be used for qualified educational expenses wasn't, and so you wind up now having to pay taxes plus a 10% penalty on it. So if you get a refund from your college that your child goes to, and you actually paid for that schooling using money from a tax advantage college savings type of vehicle, you really need to recontribute that back into the 529 account. You've got to do that within 60 days of getting the refund, and you must document it. Okay, so that means that, like most institutions, you're going to have some paper forms or something like that that you've got to do in order to send that money back to the college savings vehicle. You must use those proper forms, and you must describe it as a recontribution. I would encourage, when you make that recontribution back to that account, to avoid this tax trap that you can find yourself in, you've got to send a check. Again, I'm a fan of a paper trail, so send a check, put in the memo line, this is my 529 recontribution of the 2020 school refund amount. I mean, put that all in there so that you can document that that money did not come out and create and not wind up ultimately getting used for a college expenses. Because if you get a refund, that means that money wasn't used for college expenses because it came back to you. So you could fall into a tax trap then of, well, if the money wasn't used for college expenses, then I have to pay income taxes and a 10% penalty on it. So if you get the refund from the school, folks, and it came from a college savings type of account, recontribute that back into the account in order to avoid any issue that may potentially appear on your tax return. So a definite issue, not necessarily an issue that got created because of the CARES Act or anything like that. It's just simply an issue of what's playing out in this era of this virus and these shutdowns and these schools getting shut down. That is very unique when you stop and think about it. So you've really got to make sure that you take that money and recontribute it back into that college savings plan that the money came out of. So if you paid your money out of pocket, then hey, don't worry about it. It really is money that you can keep. But if it came from a college savings type of plan, you've got to recontribute it. So some important things to be thinking about. Thank you all for listening. We got to wrap it up and get on out of here. And of course, we will be back next week with the latest and greatest and updates on everything from the virus to the markets and everything in between. We'll see you then next week on the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning News Radio, WFLA, Orlando.